Good morning, folks. Just going to do a sound test to make sure that everyone can hear me. So if we can just give me 30 seconds, please. Okay, folks, sounds good. Welcome this morning to our 2022 Budget and Legislative Update webinar. My name is Dave Beattie. I'm the Legislative Compliance Manager at HR Talk. I've been in the organization for 23 years, and prior to that, I spent 6 years at Sars, working in VAT audit, company PAYE audits, and MTA. So quite a bit of experience on both sides of the fence, and I think that's good when dealing with legislative issues and legislative bodies. The format of today, what I'll do is I'm going to go through a bit of the 2020 budget. Those of you who logged on to the budget webinar, some of it is a repeat. But I'll quickly go through that, and then we will look at a couple of legislative updates that have happened during the year. And then we will also look at a couple of technical issues that are matters that are regular problems with clients and SARS, Department of Labour and Workmen's Comp. So we'll quickly go through those. And then what I'll do at the end, I will answer any questions you may have. But I know that people are sometimes shy, so you're welcome to give me a call or email me, and I'm more than happy to respond to your queries. So without further ado, let's move on. Okay. So the backdrop to this year's budget has been 2 years of COVID nightmare. I'm sure we can all agree on that. We can all agree that households are cash strapped, and making ends meet is not easy. We've seen an unprecedented number of job losses and business failures. At HR Talk, we do a lot of tax directives for companies, and 2020 and 2021 were record years in terms of those numbers. It's terrible to see because, at the other end of that tax directive, there's a human being who has to, obviously look after their family. So we've been through hard times. Quite unexpectedly, the South African economy has bounced back better than expected, and we noticed, SARS and Treasury identified 182 billion rand excess collection over and above what was expected. And this was even more than 62 billion more than even the medium-term policy framework. So that was a good thing, because obviously that money is going to come in handy based on where we are. Now, SARS have attributed this to buoyant commodity prices. But as you know, in the middle of 2021, we had the disaster in KZN and Gauteng with the looting and riots. So all of that eroded, it eroded some of the gains. We've also had industrial action in the manufacturing sector, and obviously the scourge of load shedding. So all of those things have not completely, but they've eroded a lot of the gains that we've made. We've seen even the economic growth estimate has been downgraded from 5.1% to 4.8%. So where did this 182 billion come from? I've just included a graph here to show you, quite unexpectedly, a lot of that has come from corporate income tax. Now, that is not a norm. Normally, VAT and personal income tax exceed corporate income tax. But you'll see that the vast majority of that money has come from corporate income. Of concern still is the 330 billion that obviously the fiscus is putting into the servicing of debt. We've seen the consolidated debt increase from 4.3 trillion to 5.4 trillion over the medium term, and realistically, with the challenges our country has, that's probably going to continue. GDP growth of 2.1% is rejected for 2020, and over the next 3 years, it's expected to be 1.8%. Now, that is clearly way too low to dent any moves that the government's making to try and reduce unemployment. I'm not sure if you all saw, but the unemployment stats came out yesterday, and they are dismal. In terms of personal income tax, South Africa has one of the highest personal income tax rates in the world. And even worse than that is this personal income tax falls disproportionately on a small percentage of the tax base. Sars are in a phase of trying to expand this tax base, obviously to achieve economic growth and generate employment and the tax collection that brings. But in my mind, this is unlikely until the informal sector of our economy actually accepts their responsibilities and starts to contribute to income tax. Now, think of your taxi industry. I think of your spaza stores. I think of any informal business. If you're not paying your pound of flesh, you are not contributing to the economy. So, just in terms of some stats, only 7 million people pay income tax. 2 million of those 7 million only pay 3%. So as you can see, 5 million people in our country pay a significant amount of income tax. Bearing in mind that 18 million people, or 30% of our population, are reliant on social grants, we've got a model that is not sustainable, and it shows that it shows that government has to make some sort of an effort to equal the playing field. And the only way you do that is you get people into employment and you get people to take responsibility for paying tax. Our Minister of Finance has followed through on the commitment to lower the corporate income tax rate. That's going down to 27% for companies with financial year ends from 1st of April 2022. And there's going to be a limiting of interest deductions and assessed losses. That's been on the cards for some time. It's going to be quite devastating to a lot of clients who haven't paid tax for a long time due to whether that be schemes or obviously just actual interest expenses. So I think we'll see more information on this in the next 6 months. The consolidated budget deficit is projected to narrow from 6% to 4.2% of GDP, still way too high. And even more concerning is the fact that the gross loan debt is 75% of GDP and probably growing. We've covered the cost to service debt, and then in terms of government spending, there's talk of the 6.62 trillion to be spent over the next 3 years. But once again, we go back to the social situation in our country, in that the social wage will take up almost 60% of non-interest spending. So your hands are pretty tied in terms of infrastructure development if 60% of your non-interest spending is going to grants. We've seen additional budget allocations, and a lot of that's going to service areas that have been significantly impacted by COVID-19, your social distress grants, your bursaries, and your presidential employment initiative. All those are good things if they achieve results. The problem is we only see if they have achieved results in 3 to 5 years. And so is it money being flushed down the drain, or is it a good investment? And then the bulk of spending will be learning and culture, social development, and debt servicing. First one, good thing, because obviously learning and culture gets people to a point where they can contribute to the fiscus. The other two, maybe not so. And as expected, economic development and community development have grown faster than any other functions. In terms of the public service wage bill, there's a meeting shortly with all the role players, and we will see how much power the Minister of Finance actually has in terms of these wage increases. I saw something to the effect of 4.9% published the other day, but I think we're going to go through the motions now in terms of strikes and picketing, you know, because I'm sure your civil servants are not going to accept that. In terms of obviously, you know, with our revenue improvements, there is proposals for 5.2 billion in tax relief across the tax bands. And then quite interestingly, we've got some sort of respite on the horizon for the fuel increases. With the Russian invasion of Ukraine, we've seen the oil price go absolutely crazy, and petrol prices are going to go the same way. We are told that in the next day or so, we will hear more on whether government has put the brakes on the levies on fuel and that for a while to give, you know, your man in the street and industry some sort of breathing space. Because as we know, if oil price goes up, fuel price goes up, delivery costs go up, and the price on the shelf of products goes up. In terms of the tax relief in the brackets, it benefits mainly the middle to lower end of the spectrum, and we've seen an increase in the rebates of 4.5%. So slightly probably on or above inflation, which is a good thing. And then we've mentioned the no increase in the general fuel levy or road accident levy, but we're hoping for a freeze on that for a month or two until we can get the fuel price under control. Importantly, progress is being made on rebuilding Sars. During the Moyeni years, there was problems. We've got 490 additional staff, and we've got 430 million in modernizing the Sars infrastructure. We've also got some interesting new sections, which I will chat a bit later. They are going to be targeting top brackets earners. And interestingly, we've heard that there's 20,000 additions to this top bracket. So the tenderpreneurs are doing very, very well in South Africa. There's going to be a continued focus on the illicit and criminal activities. Think of the liquor and cigarette industry. Progress has been made, but not enough progress. Interestingly, in that space, when I left SARS in 1999, we were spending a lot of our time investigating and prosecuting people in that industry. So not much has happened in the 20-odd years since then. SARS are going to be focusing on government tenders. Makes total sense. You know, if you're a tenderpreneur raking in hundreds of millions of rands from dodgy tenders, you need to be paying your tax on that. And SARS have promised us that they're going to be tackling people who have received bribes. You're going to pay tax on your bribe income. So let's hope the NPA are sharpening their teeth as we speak. Tax treaties are going to be looked at, and I'll chat about this a little bit later. But the big picture is SARS are looking to get a bigger chunk of tax retirement money, the tax in that space. But there has been a couple of challenges in terms of double taxation and treaties with other countries. So SARS are going to have to do their homework before they can proceed there. Another interesting proposal is that taxpayers, provisional taxpayers that is, with assets over 50 million, are going to be required to specify their assets and liabilities at market values on their 2023 annual tax returns. That's going to cause chaos because there's going to be lifestyle audits and queries flying left, right, and center. So, yeah, Sars are looking at the low-hanging fruit at this point instead of tackling the real criminals. There is talk of this discussion document that will be published later this year on personal income tax regime for people who undertake remote work. You know, where are you going to be living and where are you going to be doing this work will dictate where you pay your tax. There will be a review of the exemption of foreign retirement benefits in terms of domestic tax. So if you're getting foreign retirement benefits from, say, Australia and you're in South Africa, what will the tax implications be? There will be a review of depreciation and investment allowances. That's been threatened for some time. Those allowances are there to assist in the development of certain industries. I think the future of these allowances will depend on how successful that program has been. There's going to be a change in policy in terms of the interest and capital gains exemption, where a taxpayer ceases residence. There's going to be a lot of work in this space because there's been a lot of information published in terms of what the law says, what the law is going to say in terms of people leaving South Africa. So I think there's going to be a rethink. And there's also going to be a rethink in terms of the legislation, the transferring of R rates from one fund to another. The legislation only currently allows for one transfer. So I think there's going to be more information published in terms of how the transfers will under what conditions they will be allowed. There's a concern that profits raised from frequently traded by collective investment schemes should be treated as income rather than capital. Government proposes that a discussion document will be published. So there will be potentially adjustments in this collective investment scheme space. And then resident taxpayers may receive and retain donations from non-residents tax-free. So that will allow you to leave money offshore. You know, currently it requires you to repatriate money, but that's going to change shortly. In the retirement space, there's an intention to consult on changes to Regulation 28. You know, in terms of this space, there has been some fear-mongering over the last 2-3 years in terms of governments forcing funds to invest in local infrastructure. As I've said, these changes will be gazetted next month, as no one likes forced investment, particularly when it's low return investment. In terms of offshore investment limits, for all insurance, retirements, and saving vehicles, this is now 45%, and that is inclusive of 10% of the African allowance. Previously, it was 30%. And then, interestingly, this discussion of a two-pot retirement system, just very briefly, the two-pot system is an idea where 1/3 of your retirement pots will be kept aside and it will be accessible in certain circumstances. And one of those circumstances may be if there's civil unrest again and a person may lose their home or their family may be destitute. There's talk of being able to access that pot in the short term, and there would obviously be rules and regulations, but those will be published in the not too distant future. We've got some unanswered questions in this space. Will there be penalties for such withdrawal? Is the withdrawal a loan? How is your overall asset base of your investment impacted? And would it be possible to put money back? You know, as I've said here, it would be advisable to implement a policy in terms of what an employer would allow. So you would have general law, and then you might have to have a policy in terms of, you know, the conditions under which your employer would allow you to start digging into that pool. Sorry, just want to go back. For a 4.5 and 6.5 increase in the exercise duties on tobacco and alcohol products, no surprise there. And then we've got vaping, a vaping tax from 2023, 1 January 2023. Here we got the new tax tables on the right. There's nothing too interesting to show you on this slide. Here we've got the rebates on the right compared to 2021-22, and we've got your tax thresholds. This is an interesting change. The medical scheme tax credits, as you can see, we've had an increase. The reason this is strange is that we were told that there wouldn't be increases because of the fact that NHI was coming in and every cent was needed to fund that. So we have seen an inflation-related increase in the medical credits space. So maybe that means National Health is not proceeding as well as expected. Quite a late adjustment is your travel reimbursement per kilometre. That went from R3.82 a kilometre to R4.18 a kilometre. That is from 1 March. And then I've just included your travel table there. That changes every year based on trends in the market. And this is the table that is built into the Sars system that will dictate what your travel deduction is. And it's also the table that you would use to try and quantify what your optimal travel allowance is. In terms of that optimal travel allowance, I've just listed the steps there. You know, obviously you would have to establish the value of the car. You would have to establish what is business and private kilometers. You would establish the total kilometers, and then you would establish the fixed cost elements of this calculation. The fixed cost is taking the previous table. You'll see the fixed cost table. You'll see where your car fits in on that table, and you will take that value and you'll divide it by the total kilometers that you're going to do in the year to get a rate per kilometer, as you can see in 0.5. And then you would add the fuel costs and the maintenance costs in the bracket that your car is in to that value to get a rate per kilometer. Now, there is some confusion at the point that I've raised with PAGSA as to whether your travel allowance is your business travel kilometers times by this total rate, or the total kilometers times this total rate. I believe it's the business travel times the total rate. But I will be publishing something this in the next couple of weeks just to clarify this. Okay, so if you're going to get reimbursed at more than R4.18, it's very important to know that the cents or rands and cents that exceed R4.18 are fully taxable in the month that you reimbursed, and those go to code 3722. It also goes to code 4582, and this excess amount must be included in the remuneration in that code for determining the allowable contribution to the retirement fund. In other words, your 27.5%. Okay. And where a fixed travel allowance is paid in addition to a reimbursable allowance, both amounts are combined and taxed as a travel allowance on assessment. Okay, this is an interesting table. It's not a new table. It's just a summary table. For those of you out there, I receive literally hundreds of queries a year in terms of what goes into what codes. This table is a very nice summary of your variable circumstances. If you get a fixed travel allowance, if you get a travel allowance plus petrol, if you get a travel allowance plus a reimbursement, all your codes are going to be reflected here. And as you can see, you've also got a column in the middle that shows whether PAYE must be deducted. So keep that table as a reference point. Subsistence allowances have gone up to 152 Rand a day for incidental expenses and 493 Rand per day for meals and incidentals. As of 1 March last year, this 152 Rand was, you could pay that to employees going away for a whole day, the actual day, without having to spend a night away from home. So that will save you from having to work through slips and argue with employees, if they bought a Coke or they didn't keep their toll slip. In terms of interest rates, when I first did the slide, the interest rate increase of 24 March hadn't been published, so I've just added in the red section. So as of 1 April, all these interest rates will go up by 0.25%. The most important to you will be the low interest or interest-free loans. So if you are giving your employees interest-free loans exceeding 3,000 Rand at any one time, you need to be charging them 5.25% interest to avoid there being a fringe benefit. If you're not charging them interest, then the payroll system will work out what 5.25% is and tax that. Okay, other than the corporate tax rate coming down to 27.5% for years starting on or after 1 April 2022, these tables stay the same. Employment tax incentive, I'm sure gives people a headache, gives people gray hairs. This was introduced back in 2013 and has been extended to 2029. It's aimed at creating employment for people in the vulnerable sector, your 2,000 to 6,500 remuneration sector. So what Sars have done is, based on our unemployment problems, they've provided for an increase in 50% in the value of the employment tax incentive as of 1 March. So the incentive will increase from a maximum of 1,000 Rand to a maximum of 1,500 in the first 12 months and from 500 to 750 in the second 12 months. I've got the calculation tables there for you. But that's the easy part. So when government spoke about the ETR changes, they spoke about the increase in the value. They spoke about the increase in the expanded criteria, and they also said they'd make it easier for people to hire young people. They're succeeding in certain areas and they're failing dismally in others. It's certainly not easy to deal with ETR, and us as a payroll company are, quite frankly, still working through the logic of the legislation. We think we're happy, but there are so many deductions that are applicable in payrolls that we are on a daily basis looking at those deductions to see whether how they fall into this new formula. Now, there has been a Sars BRS published to deal with RP5 reporting in the space. But, in terms of challenges, literally on the 17th of March, PAGSA, and PAGSA is the Payroll Authors Group of South Africa, published an article dealing with issues such as the new definition of ETR monthly remuneration. Now, SARS have published documentation, but Payroll systems have to interpret that legislation and determine whether or how it must be applied in a payroll system. And to do that took a bit of to and froing. But on the 17th of March, PAGSA published this document that spoke about this concept of ETR monthly remuneration, and that is potentially different to your remuneration in terms of the fourth schedule. Obviously, from a payroll perspective, we're concerned about the reporting of these changes and calculations, because we don't want to put our clients in a position where the ETR has been calculated wrong and will be recouped on audit. So our challenges are ongoing, but I can promise you this: we are working our hardest to get to the bottom of these issues and to make sure that we comply. In terms of this definition of monthly ETR remuneration, fringe benefits must be excluded from the remuneration. So this is potentially increasing the number of people who are going to fall into the definition of qualifying monthly remuneration, your 6,000 to 6,500. Okay. So as I said, PAGSA lodged numerous queries. We are getting to the bottom of those queries, and I'd like to thank PAGSA for the use of the following couple of slides. Okay, so here's just a basic slide to show you an example of someone's earnings. The person earns a basic salary, overtime, reimbursed travel, uniform allowance, and cheap services. So as you can see there, the cash income is 5,000. Your benefits, in other words, your fringe benefits are 750. And as you can see, your remuneration is 5250. So your 5250 is the remuneration that you would pay income tax on. So what the new legislation says is, okay, sorry, before I move on to that, this is a very, very important concept, because this concept determines how that remuneration for tax purposes is further reduced. And we've got two concepts. We've got Section 34(1)(b) deductions, and we've got non-Section 34(1)(b) deductions. So in my example, what I've done is I've shown you what Section 34(1)(b) deductions are and what the non-deductions are. So at a very high level, your Section 34(1)(b) deductions are any deductions that are governed by law. Obviously, PAYE is governed by law. It's just zero here because the person's earned less than the tax threshold. UIF, medical, retirement annuities, garnishee orders, council levies, union fees are all issues where the basic conditions of employment allows the employer to deduct those from your pay. The non-Section 34(1)(b) deductions in this case are your frivolous type deductions, loan repayments, birthday club, and training costs. Now, this training cost thing, there's a long story around this, and this involves the abuse of ETR, which I'll explain a little bit later. But essentially, this legislation looks to exclude those types of expenses as they do not want training costs to prevent an employee claiming ETR. So the next slide, this slide, I don't want you to look on the right-hand side, but the slide is designed just to show you that if we look at this example that we just worked on, if we work from a net pay up or total remuneration down, in both cases, we get to monthly ETR remuneration of 1750. So to go back to our example, we all agree that the new remuneration was 5250. What was the rule that I told you? We have to exclude fringe benefits. So we have to take off the 750 and we get to 4,500 Rand. And then we have to deduct the non-Section 34(1)(b) deductions. So what were those Section 34(1)B deductions, your loan, your birthday club, and your training costs. So in this case, the person's monthly remuneration for ETR purposes is 1,750. Okay, so that is different from previously. Now, in this case, we looked at an example at the office yesterday. If this person had no non-Section 34(1)B deductions, they would be no better off in terms of the new legislation. Their monthly ETR remuneration would be exactly the same. Okay, so obviously if the employee meets the qualifying criteria for ETR, they qualify for the 22 months ETR relief. An important concept that is misunderstood by most people, okay, is whether the employer claims the ETR benefit is irrelevant. What that means is, to summarize, the length of the 24-month period is determined by the months that you qualify as an employee. If you do qualify but you don't claim, that is your bad luck. That counts as one of the months towards this 24-month limit. Okay. If ETR is not claimed in the qualifying month, it can be claimed in the next month, but obviously the caveat being that you can only claim in your 6-month RP5 cycle, otherwise you lose that. Getting out of sync in terms of qualifying periods and claims can get you an audit. So what I suggest is, in the month that the employee qualifies, you claim the ETR, and you make sure that you can show SARS that the 24 months matches claims. Moving on to quite pleasant change, long service awards. Very badly dealt with issue. Over my years, I've dealt with literally hundreds of cases where employers do not understand the legislation. So very briefly, after 15 years unbroken service, your employee can qualify for a long service award. After 15 years, every 10 years of unbroken service, they can qualify for another long service award. So just to recap, that means 15, 25, 35, 45, 55 years. They can claim long service awards. If you give it after 20 years for the first time, their next payment would have to be 30 years, and then 40, and then 50, and then 60. Okay, so don't get your unbroken periods wrong. Prior to 1 March 2022, there was a 5,000 Rand exemption that didn't apply to cash payments. The good news is cash payments are now in, so you may give an employee 5,000 cash tax-free on the achieving of 15 years of unbroken service. And we will talk about the RP5 code for that just now. Gift vouchers, they've always been acceptable as a benefit, even prior to this change in legislation, because a gift voucher allows you to acquire an asset and not cash, but obviously that is all irrelevant now. Kruger Rands were also regarded as assets, and the exemption would apply to that as well. So the long service award calculation, have we achieved the 15 years unbroken service, or have we achieved the next 10 years, the 25 years unbroken? The value of the award must be determined, and then the value of this award can be reduced by the lower of its value in 5,000 Rand. Now we've got a new RP5 code 3835. It's the long service code. And the total of all awards before this 5,000 Rand reduction / exemption must go into this code. SARS will then reduce the value in that code by 5,000 Rand when calculating tax. Now, if your long service award is in the form of the acquisition of an asset at less than its actual value, or the rights of use of an asset, traditionally you would use code 3801 or 3806, but because this acquisition and use of an asset is related to the long service, it must go into code 3835. The only bad news is that SARS has chosen not to increase the 5,000 exemption that has been in place more than 20 years. In terms of bursaries, this is quite a nice table. I've included it so you can always refer to this. And obviously giving a bursary direct to an employee, there's no change in legislation. In terms of bursaries to relatives of employees, just confirming there that you have to earn 600 or less thousand to qualify. And then what the table shows is the bursary exemption in terms of basic education, higher education, and relatives who may be disabled. Here's the IP5 codes that the various bursaries would go into. I get lots of queries on that, so keep this for your records. Just a quick reminder that salary sacrifices cannot be used in any bursary award. The legislation is chopped and changed over the last 10 years or so in terms of what's allowable, and a lot of organizations came out of the woodwork pressurizing our clients to restructure salary structures to take into account the bursary. So if, in effect, they were doing a salary sacrifice to the value of the bursary and saving the employee the tax on the value of the bursary. Well, that's all gone. SARS are of the opinion that current remuneration is current remuneration, and they want their pound of flesh. So you can't use a salary sacrifice element when doing such planning. Gift vouchers and other benefits. I've had tons of queries from clients over the Christmas period saying to me, you know what, we can't afford to give bonuses. We're going to give 3,000 Rand gift vouchers. Or we can't have a Christmas party because of COVID. We're going to give people meal vouchers. Folks, those are all got value. None of them qualify for exemptions. They are all, their value has to be taxed through the payroll. Providing a voucher to an employee for a meal is very different to providing a meal at the employee's premises during the course of the business day. That is exempt from tax. But a voucher or some sort of a gift for good service is not going to be exempt from tax easily. The one potential exemption that I can think of is a potential birthday or some sort of a voucher or gift as a result of some sort of family bereavement or some sort of achievement. Potentially, SARS would look at that as some sort of a humanitarian gesture. But you're welcome to contact me if you've got any concerns. Additional PAYE deductions. This is a relatively new concept, and a lot of this involves around the pension space and why it's been introduced. Quite a lot of taxpayers have more than one IP5 coming in on an annual basis with their pension. So just using a scenario, you might get 10,000 from one pension and 10,000 from another pension. Remember that each of those funds taxes the amount individually, and when the employee hands or the pensioner hands in their tax return, that they owe SARS tax, because the sum of the deducted tax is not equal to the actual tax calculated on assessment. So SARS are saying that a lot of pensioners are owing SARS money, and that increases administration of trying to recover this over a period of time. So what Sars have said is they will be advising pension funds via some sort of a directive to deduct extra money from those pensions so that the pensioner does not have an amount owing on assessment. We have seen some challenges because not all of the funds are ready to do that. And I'm pretty sure not many were able to implement these changes in March as per the legislation. Okay, so this is just a technical issue in terms of the anomaly where self-insured risk benefits are in place as part of a contribution. This was not seen to be a defined contribution component. As such, the total fund contribution was seen as a defined benefit, and hence the fund was a defined benefit fund, even if that wasn't the intention. So the self-insured risk contribution should have been excluded, and we've got a couple more definitions in terms of the 7th schedule. Clearer definition of the risk, what a risk benefit is, and in terms of that, think group life, dread disease, life, funeral. Okay, definition of a risk benefit policy, and the definition of what a defined contribution component is. A retirement fund that provides a defined contribution component, retirement benefit, and self-risk benefits is a defined contribution fund, which most of the funds are. And then the fringe benefit is therefore the total employer paid contribution. The value of the risk premium will be the cost to the employer in terms of the actual contribution. Quite interestingly, the majority of our clients are not aware of the fact that the defined contribution funds actually have these risk benefits built into them. It's important that you as an employer are able to separate the risk contributions out of the fund, and that your payroll set up to separate unapproved from approved contribution funds, and ideally split the contributions into the individual components on the payslip. Your unapproved contributions would be taxed as a fringe benefit, and the only way you're going to know whether they're unapproved is if you're able to say to your fund manager, included in the company's 10% is the investment portion and these risk contributions. Please provide me a breakdown so that I can provide that to my payroll administrator and I can get it right. If you're not taxing the unapproved contributions as a fringe benefit, you are breaking the law. Okay, so these changes are applicable from the 1st of March. In terms of biannual returns, SARS have told the Payroll Auditors Group that we are seeing a lot of companies that are not submitting the actual the initial IP5 contribution that covers the period March to the end of August. So they going to be imposing penalties, higher penalties for non-compliance. I don't know how people who don't use a sophisticated payroll system comply in this space, because we're getting ever increasing technical specifications that have to be met. And, SARS will be using readily available data, from your tax submissions to do estimates in terms of this submission and penalize you. So if you're not on a decent payroll system, or you're not aware of the technical specifications, or heaven forbid you're not submitting biannual PAYE recons, please contact us immediately. There is talk, and we're quite far down the road in terms of SARS implementing monthly IP5 submissions to do away with the biannual and the annual return. And quite interestingly, I saw there was talk of more information being required to be submitted directly to SARS, and SARS reducing the number of people who actually have to submit a tax return. So then in the not too distant future, we can have a scenario where all of your information is submitted to SARS, and you don't have to submit a tax return because SARS will do a self-assessment on you. Obviously, if you've got a travel allowance, rental income, or any other income where there is not a requirement to submit information by a third party, you would have to submit a tax return. So interesting times ahead. SARS validations, we've seen this. We get literally hundreds of these relating to our clients on a monthly basis. SARS are checking accuracy, completeness, and actual PAYE calculations. What they do is if there's calculations are out of their sort of thresholds, they send a letter back and you have to provide an explanation. Certain categories of certificates are excluded, but you know, for example, if there's additional tax that's been deducted, that would be raised as a query, and you would just say no, the employee's got multiple sources of income and it's asked for additional tax to be deducted. But if too little tax is deducted, you would also have to draft a letter explaining why, and that can get messy. The 14-day rule to submit tax certificates. This has always been part of the law. So certain circumstances, you got 14 days to submit a tax certificate. I think death is one of those. Not so easy to do. So technically, if you don't meet that, you're breaking the law. But the Payroll Authors Group has taken this up on behalf of industry to try and get this period extended. Ceasing tax residency, very hot topic. As I mentioned to you earlier, there are tax implications to retirement funds if you cease to be tax resident. There has been some obviously scare tactics by SARS in terms of making proposals to tax earnings. There have been counter proposals to delay this tax liability so that we don't have this deemed withdrawal on immigration. And you know, the proposal is that the tax liability will only be paid when the person actually gets paid out by the fund, not on the day that they cease to be residents. You know, the challenge here is most of this money stays in South Africa anyway. SARS are paranoid that money's going to take flight and they're not going to get their taxes. And then there's clarity being sought regarding this introduction of the 3-year waiting period. The issue's been looked at, and there are massive amounts of issues that have been raised. Quite concerning, you know, if a person legitimately wants to leave the country and follows all the rules, that their 3-year waiting period is imposed. That means the majority, the money that you need to start your new life in a foreign country is tied up for 3 years. That's hugely problematic. Cryptocurrency, very much in the spotlight at the moment. Obviously, we've seen, particularly in the IT industry, there's trends where IT consultants have tried to avoid the taxation of their earnings by asking to be paid in cryptocurrency. Folks, that's not a way to avoid tax. The value of that cryptocurrency at the time of the accrual is the fringe benefit that the employee is getting and the value on which they must pay tax. Obviously, if you're buying cryptocurrency as an employee, just as an investment, then capital gains tax would need to be considered on your transactions. If trading is your objective, then it's a completely different kettle of fish. Then normal tax would be applicable. SARS are obviously getting information from third parties on this. So don't think that you're trading crypto on the sly and no one knows. You never know when you're going to get an assessment from Sars. Okay. In terms of SDL, we all know that the enterprise can only be registered for SDL if the value of their remuneration paid is 500,000 or more. There's been some challenges over the years as to when do you register. PACS have made a proposal that the deemed remuneration total is recorded on RP5s for the prior year. And then obviously in your current year, there's some sort of a comparison to be made to see whether you've over the threshold. Obviously the benefits to this is you can see actual figures and you're not just thumb sucks. So you're not at the mercy of SARS as to the decision made here. And then once the decision is made, the SDL would be applicable for the whole year, starting from the new year. The Learnership Tax Incentive, this was first introduced in October 2001. We've had numerous extensions, with the most recent one being to April 2024. It was introduced to encourage skills development and job creation. There's obviously been a lot of manipulation in the space, so there's been moves by SARS to improve the targeting to ensure that employers are training learners in certain skills categories where there is a high demand for those skills. And there's also an improvement in future policy analysis in that you have to fill in certain forms, notably the RT 180, to make a claim for this allowance. Only the lead employer can enter into an agreement with the learner, and this is the employer paying the remuneration. Employers receiving additional, obviously, how this works is you would obviously claim the remuneration for the employee in this learnership. The employer then gets an additional tax deduction per person over and above that salary expense for all employees who have entered into a formal learnership contract. The first allowance that they get is an annual allowance, and this is every year of the agreement. Obviously, it's pro rata, so if you enter into this agreement halfway through the year, you would only claim a portion of it. And then in the year of completion, you claim the completion allowance. The value of the allowances differ depending on the NQF level of the learner. And as I mentioned previously, the value of the allowances increase if the learner has a disability. Remember, remuneration paid to learners is subject to normal PAYE legislation and the requirements of the national minimum wage. I've done a table there for you to see what the NQF levels are and what the various annual allowances and completion allowances are. That's very straightforward. Just keep that for your record purposes. Just a little bit on interns. Interns are useful when applying for skills shortages. That intern may be able to come in, fill a gap in your organization and get some practical experience. But the difference between a learnership and an intern is obviously there's no specific time frame to the internship. It would depend on the needs of the company. It's common practice for an internship for the employer to pay a stipend to cover food and transport. Most likely that would be below the tax threshold, so there wouldn't be PAYE, but don't lose sight of the fact that there might be Uif, SDL, or COIDA. And the advantage of an internship, the intern might be able to be offered permanent employment. A learnership, on the other hand, it must be for a recognized national qualification. Those people in a learnership would allow the employer to claim an ETR, so that there's another benefit of an actual learnership. In terms of BE points, up to 25 will be allocated if the employee is taken on for full-time employment. And don't forget the difference between the annual and the completion allowances and the actual remuneration that the employer can claim. Going on to a nice meaty topic that is causing a lot of teeth gnashing is our home office concept. The home office concept is not a new concept, but it's been thrust into the limelight by the COVID pandemic. As we know, overnight employees were dispatched to their places of residence, and somehow overnight we had to remain productive and client-facing because the show had to go on. Not so easy though. Not many people's residences are set up to allow for this. So we saw lots of weird and wonderful things in this space. But the COVID is easing off. We're starting to see a new normal in that companies no longer need as much space. We've seen obviously less traffic on the road, and we've seen a complete change in the work dynamic. People are working from home, and somehow people are managing to still operate. In terms of the tax legislation, there's no specific authority for an actual home deduction. So we're going to look at Section 11A as your general deduction formula in terms of what expenses a person conducting a trade can claim. And then the naughty section, Section 23B, the section that says that you can't claim any private or domestic expenses as an employee. But as we know, there's exceptions, and the home office issue is one of those exceptions where we're now in a situation where there's your home is used partly for trade and partly for private purposes. And how else do you claim a home office unless you're using it partly for trade? So we're going to talk about the home office deductions, and we're going to talk about the apportionment of expenses to cater for the home office. First step, your employer must put it in writing that you are required to work from home. So that can either be in a letter, employment letter, or change to the employment contract in terms of an addendum. It's important that more than half of your working hours are working from that home office. The term mainly is important in the adjudication process. So if you're not mainly working out of that office, you're going to be excluded from claiming a home office. Working from home must also constitute more than at least 50% of your tax year. So you work mainly from home in that tax year. The employee must have an area of their home which is exclusively used for this purpose. So this is probably your biggest challenge when setting up a home office. In my case, I've converted my dining room into an office. It is, if you walked in, you'd see the numerous screens, 2 printers, scanner, my laptop. But, oh dear, in the corner is a guitar. My son's guitar's in the corner. Sars would probably say that it is not exclusively used for this purpose. Your office must be specifically equipped. So as I've said, I've got a huge table and I've got the right furniture for my home office. And it must be exclusively used by me. That's a challenge because sitting opposite me is my son working all on his stuff. So another potential challenge why I will not qualify for a home office deduction. So the types of expenses that can be claimed, and when we look at expenses, we look at common expenses, so the expenses common to the residents, and then we look at expenses specific to the home study. So the common expenses are going to be the rents you're paying your landlord, the interest you're paying on your bond, the repairs and maintenance on your home, the lights and water, the maids, wages, household insurance, rates, security. So all of those are deductible expenses. But then we also have specific expenses, and those are the wear and tear on the assets in your office, books, and repairs that are specific to your study. SARS do not allow you to claim home, phone, cell phone expenses, general home repairs, and stationery. So if you are maintaining a home office and you're incurring those expenses, you must get into an agreement with your employer to have some sort of process of reimbursement. In terms of the process, calculate the total square meterage under cover of your home. Apply this, work this out as a percentage, okay? Let me go back to step one. Calculate the total square meterage. You would then calculate the square meterage of your home office. And so you've now got a percentage, whether that be 10% or 20% of your home. You would then apply that to the expenses that are common to your home, and then you would add expenses that are specific to your office. Okay, so let's go through those steps. My home, as an example, is 100 square meters. My office is 10 square meters. So that means I can claim 10% of my common household expenses as per my list. I then add expenses that are specific to my office, wear and tear, as an example, to come to my deduction. There's a downside to the home office issue, though, and that is capital gains. Now, what I've done is I've just included a very, very basic example for you to work through. And the reason I've included it is people are very keen to go on the home office bandwagon. You can be guaranteed that if you've made a home office deduction, SARS are going to flag you for an audit when you sell your home. So you could get into a situation where you sell your home later in your career, maybe getting on, you downscale. And when it goes through the legal process through the deeds office, a query is raised by SARS and you have not done recoupment for capital gains purposes. So what I've done is I've just used a very basic example of a home that's sold at a profit of 2 million. You owned it for 10 years and you used the home office for 5 years. So half the time you owned the property, you used it for home office purposes, and 10% of the home was used as a home office. So very simply, you would apply the 5 over 10, so half of your time in your home as a home office, and the 10% home office percentage to the 2 million to arrive at 100,000. Remember that every year that you get a CGT exemption of 40,000, so you've now got 60,000 left. Of that 60,000, only 40% is included in your taxable income. So that means 24,000 is included in your taxable income. And of that 24,000, you'd pay tax at your marginal tax rate, depending where you fall into the tax tails. Hopefully that's not at 45 or 41%. Remember the 40,000 exemption. Remember, there's only a 40% inclusion. People freak out about capital gains. Capital gains are still a low price to pay because only 40% of the gain is included in taxable income. So in this case, it might be better. You might end up paying tax of 8,000. Maybe over the 5 years that you ran your home office, you got a benefit from a home office allowance of 20,000. It's worth it. Just don't lose sight of the fact that there is this clawback of CGT. So what are the challenges in terms of the home office issue to date? SARS has rejected up to 80% of the home office claims. Quite aggressive, that. Why? Officers do not meet the requirements of a home office. People are working in the spare room. People are working in their sewing room, their craft room, their home gym, the passage, the kitchen table, the dining room table. All those are not meeting the SARS basic requirements. Secondly, the office is not used exclusively for business purposes. So you're not mainly using the office, or you're a rep and you're out and about and you're only in that office for an hour or two in the evening, you're not going to qualify. Your office is not adequately equipped. SARS come and have a quick look, and they don't see any equipment in there, so they will throw out this claim based on the fact that you're not adequately equipped. It's mainly not used. We've discussed. You've done an incorrect apportionment of the expenses, so you've used the wrong figures. Your maths is not good. Your claim will get limited. You've claimed the incorrect expenses, and as an example, a lot of my clients want to claim the capital portion of their bond. No, you can only claim the interest portion. A lot of people have had stationery denied and cell phone expenses denied. Tax refunds get tied up for months. Is it worth the effort and the stress? Most of the spaces that I've looked at with my clients are very small. The gain is very small. Quite frankly, in a lot of cases, it's not worth the effort. Employee transfers. Okay, legislation changed a while back in terms of that. So basically, we got three broad exemptions in terms of transport costs, transfer costs. Sorry, that is transport costs, property sale costs, and temporary rental accommodation. Just very briefly, the transportation costs of family and possessions are exempt. So as long as you give those invoices to your employer, they can pay them exempt. Disposing of your current property, those costs are also exempt. And should your employer send you to the other end of the country, they can pay for your accommodation for up to 6 months tax-free. So I've done a list of qualifying expenses here. You can look at those in your own time. Pretty self-explanatory. Non-qualifying expenses, very limited in this case. Architect's fees for new residents, SARS will not allow that. And if you make a loss on your previous resident, they won't allow you to claim that. Importantly, all the qualifying expenses that your employer pay on your behalf must go to RP5 code 3714. And any non-qualifying expenses go to 3713, which is your code for other taxable. So just make sure that you split those correctly. As of 1 March 2016, the practice of just giving your employee a blanket 1 month basic pay tax-free was stopped. You need to actually keep a list of actual costs that you incur, give those to your employer, and they can reimburse you. If you're an employer, maybe set a policy of what costs you are willing to incur and the process of reimbursement, as those that process will be audited. And it's always nice to have your ducks in a row should there be an audit. Care must be taken for employees on probation. Just think of a scenario where you send someone on probation from Durban to Cape Town. It doesn't work out and you have to dismiss them. How is the recoupment of the costs dealt with? Do they pay it immediately back? Or is there some sort of a loan? Is there some sort of a fringe benefit now that's going to incur because you're writing off costs? These are all issues that you need to consider, and it's good to have a policy for so you don't get into trouble. Okay, I've listed some 2022 SARS BRS SARS Business Requirement Standard changes. Guys, I'm not going to go through these. Please look at these in your own time. They relate to IP5s. If you're outsourcing your payroll, these things will be managed for you. Otherwise, RP5s are not accepted. Okay, just in terms of the long service award, again, I've just included a table that will assist you in determining, in terms of your policy, whether the long service payment has to be taxed, what portion has to be taxed, and what code it has to go to. All self-explanatory. Keep it simple, and if you need help in this space, please chat to me. Here's just another BRS update in terms of RP5 and payroll codes. Uif Compliance Certificates. We've had huge challenges with the UIF system. When this was introduced in 2021, we thought this new online system was going to be the miracle we've been waiting for. But alas, the process has been fraught with challenges. We've had massive rejections. We've had people who have had rejections in terms of their RP5 certificates for up to 18 months. Without being able to get your Uif compliance certificate, you've got the challenge of not being able to apply for tenders. And this has been going backwards and forwards with the Department of Labour via South African Institute of Tax Professionals, SAICA and PAGSA. And we are getting to the point where some bad things are going to happen. There's talk of Supreme Court actions. There's potential damages for people who are losing jobs because tenders weren't got because the Department of Labour dragged their feet with errors on these files. And there's soon to be an expose in a national newspaper and potentially carte blanche as to the challenges and the fact that the Department of Labour at very high levels seem unwilling to move to fix these issues. PAGSA, SAIT and SAICA have made proposals that will go a long way to preventing these challenges, but they're falling on deaf ears. In terms of COID, we're fast approaching COID filing season. In fact, it starts tomorrow. It starts on Friday the 1st of April, April Fool's Day. The COID threshold for the new year that started on the 1st of March is 529,264. Please put that into your payroll so that the COID threshold is maintained. In terms of the COID minimum assessment, that is increased from 1,284 to 1,342. Not many people know about that. So even if your COID assessment is null, you will pay 1,342 because that is the minimum assessment. The COID return of earnings filing season opens, as I said, on the 1st of April, and it has been extended from the 31st of March to the 31st of May, as is standard practice. If you don't get your return in by the 31st of May, you are going to get penalized. Basic conditions of employment earnings threshold went up as of 1 March to 224,080 Rand and 48 cents. Anyone above this threshold does not receive overtime or need not receive overtime, and they do not get automatic protection in those areas of those bulleted points. Earn under the 224,000, you are protected by the BCA. Earn above in those spaces, you are not. Interestingly, the national minimum wage was gazetted on the 17th of Feb. The new national minimum wage per hour is 23 Rand and 19 cents. Interestingly, also that applies to domestics as well. And farm workers. The only people under that rate are your public works program workers, and their rate is 12 Rand 75. The national minimum wage, the BCA defines an employee to exclude independent contractors. The national minimum wage defines the work in the same manner, but does not exclude independent contractors. The effect of that is independent contractors must be paid at least the national minimum wage. Or, well, I should hope they do. This does not, however, apply to the ETI and UIF Acts. These acts see independent contractors as employees if their trade is not seen to be independent. I've included some rates there for you to just look at. In terms of the Skills Development Act, you can have a look at those in your own time. And then, courtesy of PAGSA, I've also included the slide, which includes the definition of worker in terms of the national minimum wage. And what is the definition of wage? Very, very critical that you go away and look at this definition of wage, because a misunderstanding in this space can get you into a lot of trouble. So in effect, wage is the amount of money paid to a worker in respect of their ordinary hours of work, not any other benefits, or their ordinary hours of work. And then I think that this is finally, we can have a look at POPI. POPI is here. All the extensions have now been passed. You should have a POPI policy, and you should be living POPI. Just to remember the employment lifestyle from a POPI perspective in terms of engagement, onboarding, management, and termination. If you have problems in the POPI space, chat to me and I'll get one of our ladies to consult with you. Folks, the session's gone on a bit longer than I'd hoped, but I hope you got value from that. Just want to have a look at Jonathan to Samaya. Samaya, if you want to have a chat to me, please drop me an email. My email is dave@hrtalk.co.za, and I will be happy to help. Any other questions? I don't see them. Once again, thank you for logging on. Thank you for bearing with us. Please be patient in terms of some of these legislative issues. I can promise you HR Talk are right at the cutting edge of changes. We work very closely with PAGSA, the Department of Labour, Sars on these issues. We meet with those people regularly. So if we don't know it, believe you me, no one else knows it. So reach out if you need help. We're more than willing to help and get things right first time. Thank you again. If you want to listen to this, please, it will be put up on YouTube. You are going to get the slides. Candice will send them out probably this afternoon. No, she'll send them out tomorrow. Thank you again. Have a lovely day and stay safe.